and getting things rolling here. Want to really appreciate everybody for taking some time to sit down with us today and talk about some of the risks that investors are facing. We know how important your guys' time is. We appreciate you taking 15 to 20 minutes spending it with us. That being said, we do have a lot to cover, but we are going to try to buzz right through it, keep it short, sweet, and to the point. For those of you that haven't attended a monthly Outlook webinar with us before, typically we do them on the third Wednesday of every month. However, even after having lunch with Janet Yellen last week and letting her know that she is clearly in conflict of our monthly webinar, she continues to do her press conferences on the third Wednesdays of the month. So I believe we may look to change this, probably take the high road. Obviously, she didn't really get the message. But actually, in all seriousness, we may look to change these. Typically, what we do is we go in and we actually spend some time kind of digesting our portfolios. The chief strategist with Tesseract Asset Management, Kevin Tuttle, will join us from time to time, talk about some larger macro secular risks and kind of some viewpoints in the market. Today, we're going to do something a little different. And we're going to actually, based on a lot of the feedback that we're getting from advisors out in the field as we're talking to them, we're going to take some time and explain a little bit how our portfolios work and how some advisors are using them to help possibly decrease some of their clients' risk profiles as this market continues to top, maybe get a little top heavy, go into consolidation and continue to run. So what we're going to do is we're going to go ahead and get things started here with Kevin, who again, Kevin Tuttle, obviously just released his latest book, which is the second one, An Evolutionary Perspective of Investment Risk. It's available at Barnes & Noble, Amazon, all those good things. Veteran of the street for about 25 years. He's going to join us, discuss the fundamental, geopolitical, technical, and behavioral risks involved that some of the investors are facing. Talk about how a lot of the time it's the lightning bolt you don't see that'll get you. Then we're going to obviously get into and give a brief explanation of our strategies and discuss how they could be used to help circumvent some cyclical drawdowns and go into the actual portfolios themselves. After that, we're going to open it up real quickly just into a simple Q&A session. We do plan on actually spending quite a bit of time in the Q&A section and hopefully getting through the majority of some of this stuff here quickly. So again, one last time before I get started, just want to make sure that everybody can, in fact, hear my voice and you guys can see the screen. So if you could do me a huge favor, type a yes in the chat section for me. Let me know that you do hear me, audio is okay, and that you can, in fact, see a slide with the evolutionary perspective of investment risk. Also should see where we're available. For those of you, because I do see a few new folks in here, we're an ETF strategist based out of Orlando, Florida. We offer 3 separate portfolios. You'll see some of those today. Primarily work with Placemark Investments and allows us to be available at TD, Fidelity, Charles Schwab, Pershing. So if you guys have any questions, feel free to let us know. Looks like we got a lot of yeses coming through, so that is very, very good. One more real quick housekeeping thing. We will actually provide a playback for you guys. So we'll have that available typically within about 24 hours. You should see an email from a marketing department discussing how you can get that. And if you have any questions, always feel free to obviously give us a call. So I guess without further ado, I'll just go ahead and get things started. Kevin, I'm going to go ahead and turn this over to you. We'll get things going from there, and then I'll pick up as soon as you get done. So ladies and gentlemen, Kevin Tuttle.
Thanks, Josh. I appreciate the introduction. I wasn't sure if I did something wrong, but as soon as you introduced me, the market dropped 40 points. So I looked up, and what we have, obviously, is Janet did not listen to you, as you said, and decided to do her press conference at the same time we're doing the webinar, and she just announced that the taper is going to be reduced by another $10 billion, which everybody expected. So we're down to $55 billion a month in purchasing. Also, she did mention that she's going to be accommodative for a considerable time going forward, which really, again, goes back to Bernanke's tightrope that she's inherited. I also wanted to, before we go on, thank everybody for coming to the webinars. We've been doing them now for approximately 6 months, And I get lucky enough they allow me to come on and banter to you all and have an open forum where I can talk about the macro stance on the market. And I think also it works really well. I spend a lot of my time, I'll cover a few things today, and Josh, if you could flip the slide, but I will do a couple things today just as an overview of where we've been, but then at the end I hopefully can answer a lot of questions that you guys may have. It's difficult to guess really what questions a lot of advisors may have out there. So the Q&A is become so very important, so I'll probably really come back into play and take a lot of this at the end. What you're looking at here is, as everybody knows, and Josh mentioned that there are a few people, or actually quite a few people that are not yet our clients or are first-timers to the webinar. So I want you to understand that we are a shop that focuses on fusion analysis, which is the unification of fundamental, technical, and behavioral finance. We take the emotions of the marketplace, we measure those emotions, same with the technical aspect of the market, as well as the quantitative, fundamental aspects of the market. So things of the nature of what's happening today, some of which we actually don't put into our measures, but can be read through the measures of our quantitative analysis, and one being Putin. So as we all know, that this has been a very, very big issue. So let me start with the chart that you're staring at today. What you have is the S&P 500 since January of 2007. What I'm trying to show is the Great Recession, as you can see with the downward curve and the two red lines curved down in a parabolic move, as well as you're looking at the cyclical bull market that has transpired since, which we believe personally that has been induced mainly by what you're seeing today, and that is the Fed, whether it be Bernanke or now Yellen. Over the last 6 months, we've spent a lot of time talking and discussing the risks in the marketplace. The last piece that we put out, and for everybody that knows, I put out a weekly piece. It's called The Morning Cup of Joe. It also, if you don't want to read it weekly because that's more of a technical piece, we put it out on more of a generic stance on a monthly basis called The Monthly Cup of Joe. And then on the quarterly, we don't put out a monthly piece. We just put out our quarterly piece, which is essentially the quarterly report, which again unifies the fundamental, technical, and behavioral aspects of what we look at. And if you look back at last week's Morning Cup of Joe, the statement, well, there's two main statements, and that is, number one, is risk always seems least when it's the highest, and risk always seems the greatest when it's the lowest. And that's true. That's part of behavioral finance. It's the way people look at the world. Now, whether or not you can equate that or whether or not you can measure it is debatable all in its sense. We believe you can. And what we're looking at now is we're watching on a technical basis the market an extremely high and moving towards a parabolic move when you look at it from a 5-year basis. And we've spent a lot of time again, and I'm not going to reiterate everything today, but we spent a lot of time on what could be breaking down economically, whether it be retail sales, whether it be the consumer confidence, again, behavioral aspect, whether it be the economics and the fundamentals. Are we really getting GDP where it has to be to get this kind of sustainable growth? The fact that the Russell 2000 is now in the 5th percentile of its high, of any time it's ever been this high. It's within that 5% docile. What is it that we look at valuations? Is this a runaway, and where is that risk? So when we analyze the market in general, we have to look for the second issue, and that is the lightning bolt that you don't see, and that's the one that's going to kill you. When you look and ascertain the direction of a market, a lot of people will jump on the bandwagon late. They wait for a lot of the move to transpire, but when the move starts to accelerate, they jump on the bandwagon, mainly because they get pressure from their friends, pressure from other clients, pressure from, oh, by the way, look what he did. Oh, by the way, should I switch my portfolio over here? And that succumbs to everybody in the marketplace, and then you watch that pressure come into fold, and that's what pushes the market to the pinnacle or the apex that you'll get when you come to the end of a bull market. Hence, risk is the most when it seems the least. But what is it that stops that? So we know everything that I've already said. Everybody on this call probably gets everything that I just said. But the question, the real question that advisors have to ask themselves is when to turn. And what are the roadsides along the way to look for when that turn comes? And we've spent a lot of time talking about volatility. Josh will probably mention a little bit today about the cyclical cycle and about stagnation of volatility. It's kind of a weird term. It's almost an oxymoron. But he'll talk a little bit about that. But I think what you look for is when you get a semblance of all of your data lining up in one line. So if you take your fundamental and your technical and your behavioral and you add them up, and all of a sudden, if you look at the Einstein, what are the positive, what are the negatives, things start moving into the negative column. But the price is the last to go, or one of the last, not the last, but it's one of the last to go. So, but everybody focuses on price only, the movement of the market, the return of the market. But we're here today to talk about the other side of it, the things that aren't added up that could potentially happen of a warning sign when you get to these levels. So, Josh, if you could flip the slide one more time. One of the things that we're looking at and we brought up last week is the talk of the town in the last month, as everybody knows, and I'm not trying to reiterate the sensationalism on TV, but one of the things that we've talked about obviously is what's going to happen with Russia, Ukraine, and how could that affect the marketplace? Well, in the very short term, it didn't affect the market at all, other than the fact we took a 5% drawdown and then a 5% run back up, and now we've had this volatility on a daily basis, which has averaged over 150 points on the Dow Jones every single day for the last 8 trading days. So, yeah, is there some volatility? Sure. Sure, absolutely. There's a little bit of increase on the daily volatility aspect of the marketplace. But you're getting that daily activity and you're getting stagnation. You're not getting any price movement. If you look at where we are today, even though we had a banner day the other day, we're really right now at the point where we were before we had the sell-off and the concern about Putin. But yet, really what fostered the downturn was not just Putin, it was China. And one of the things I'm going to bring out today is a possibility. And I'm not bringing it out in intention to saying, hey, this is going to be the catalyst, the straw that breaks the camel's back. What I'm saying is that this is a possibility of what to watch on the horizon when all the factors start lining up on the wrong side of the column in the Einstein's negative column. And when you look at it and you say, okay, you have this situation that is arising on a geopolitical issue with Russia, and yet no effect. Everybody sneezed, it was over, 5% drawdown, went back up, everything's fine. Okay, nobody cared. Maybe. The first people out of the gate and the buyers that come in after that indicate that they just missed out and they wanted to get in as much as they possibly could. There was a guy 20 minutes ago on TV, on CNBC actually, from American Century, and I'm not saying anything negative about American Century, but he said he's buying risk wherever he can. And I thought to myself, now, 5 years after, you're buying risk wherever you can. I'd like to see if 5 years ago he was saying he was selling everything in the market wherever it could be. And again, I don't know who he was, and it was a glimpse on TV, but it just made me think about all the possibilities of not understanding and why people, advisors, and also clients get confused on when to make those choices, because the key is the when. When do you make those allocation shifts? So again, I'm going to round it back up, and I got off on a little tangent, but the point is that China came out with some news, and the news was twofold. On the top, you'll see it says China retail sales year over year, and on the very bottom it says China industrial production. And in this is really the two factors that you want to look at when you look at China. There's some other factors in GDP and so forth and so on, but these are very, very, very important and really stem the tide of the rest of the factors that come out. And they came out on Friday, and notice that both on retail sales year-over-year growth and industrial production year-over-year growth, you've had a decline of 20% on both of them, where once you were trading at, or industrial production was 10, even 11. Retail sales was as high as 15, now is at 11, and now industrial production at 8. And the chart in the middle is the Shanghai index, so you can see where that is. And it just shows this is what's transpired over the last 2 years. And what is it showing you? Well, it's showing you volatility with stagnation of price. And right now, this market is trading the lowest it has traded since the bottom of 2009. It actually is a little bit lower, and then you'll be down in the very lows in the Great Recession. And why is this important? Well, China is the second largest economy in the world, if anybody didn't know that already. The other factor is the fact that China has a debt to GDP issue of 180%. I mean, we were concerned about Spain when they were at 160. China has 180 debt to GDP, and if you look even further down that, they've just decided just the other day that they're going to go ahead and allow their corporate bonds to go belly up, the ones that are no good. Whereas they don't have to, because that's the whole part about being a communist country, is that you can hide anything you want to hide, and you can put it on a balance sheet essentially indefinitely, similar to what we did here. So again, is this a concern? The slowdown is the concern. Where they hide their debt and how they allow bonds to go belly up, so forth and so on, is just one factor. And if you add that factor and say, okay, well, that's great, I think still we're going to go forward. But let's add some other factors in there. Is anybody aware that since January, coffee prices are up 71%? Does anybody know that wheat prices are actually up 15%? Anybody realize that hogs are up 33%? Soybeans are up 15%. Cocoa, wheat, they're up almost pushing 20%. And yet your lumber and copper are falling. So if you watch lumber and copper, that's infrastructure. If you watch everybody says, well, is this weather? Well, maybe it is. Maybe the fact that we've had really bad weather in the Northeast is controlling these prices, and that very well could be the case. I mean, that's what Yellen is going to be leaning on in the conversations today that she's going to be having. But if you have weakening economies and you see an industrial production in the second largest economy in the world, and then all of a sudden, God forbid, should there be some sanctions put on Russia, they're going to, in turn, come back and say, well, considering they control 30% plus, debatable right now, of the energy going into Europe, well, nat gas prices overseas, you can only imagine what's going to happen to those, which obviously drive their energy prices, and then, in turn, look to China having problems with that. So my point is this. I'm not saying that it's China. I'm not saying that it's Putin. What I'm saying is that things are starting to add up that just don't make sense and are adding to the risk aspect of where the market is today. But the market continues to push higher. We talked about financial engineering. We've talked in a multitude of ways. We talked about how earnings are created, not actually, no pun intended, earned. And we've also mentioned how, now that the Fed is tapering, how does Yellen actually taper and be able to make sure that she is there holding up an economy that, I'm not going to say we're faltering, but we're not exactly the strongest that we should be. Any whiff or any breath could create that to turn. So when you're driving down the road and you're going 100 miles an hour and it starts to rain outside and you see a sign that says slippery when wet and a curve ahead with an S in front of it, you have a tendency to step on the brake. And if you don't, then you're making some big mistakes. And that's all I'm telling people is like, look, we have our growth portfolio that is completely invested into the marketplace. And that growth portfolio is going to do exactly what it needs to do, and it's going to stay involved with the market while it needs to stay involved. And when the cyclical shift of the market goes and it turns over, it will be time to hedge, and it will be time to move it into the other direction. And if you look at TAM Portfolio's conservative growth, which is concerned about volatility, it started to hedge because the volatility is high, and it's starting to protect itself, yet it owns positions that are high growth. I mean, it owns TAN, which is an ETF focused on the solar companies, which is up 40% this year. So, you can have the best of both worlds if you know where to place it and know what the risk is. And yet our income and our tactical income, it's our greatest performer this year so far, strangely enough, is up approximately 4%. And again, because you're starting to see that positioning and looking for value in the search for yield, where it's yielding about 6.2%, of which 50% is tax-free. So when you look at the positioning of the marketplace and you look at risk across the board, the biggest question and the reason that a lot of people get onto these calls with us is to look at how do you quantify when to make those allocation shifts and what actually is the tipping point, because everybody is afraid of missing out. But you've got to be able to have confidence in making that choice, and that's where it comes down to is, does the advisor have the confidence to make the choice? Because as the old bear analogy, when the bear is chasing two people in the woods, an advisor doesn't necessarily have to always outperform the bear. It just has to outperform the guy next to him, and that's how he gathers assets. You know, you have to do it well, but he's got to have that confidence without having to do all the research and all the back work of understanding when to make that shift. He's got to be able to make that shift and lean on somebody to help him make that choice, and that's what we're here for. So again, I'm going to end it here and turn it back over to Josh. Leave myself listening to the rest of the conversation until there's a question and answer session at the end. And again, I'd like to thank everybody for at least listening to my banter for now, and hopefully we'll have some questions afterwards.
Thanks, Kevin. I think, and if you stay on for a little bit, Kevin, what he's alluding to obviously is what some people will call, asset allocation 3.0, but I think as things have evolved, obviously through the 80s and the secular bull market that happened from 82 to 2000s, a lot of folks went out there and did what we would call asset allocation 1.0, kind of that buy and hold, utilize diversification, decrease risk on more of a linear standpoint, and be able to retain assets that way. As we kind of turned into the millennium, a lot of advisors began to ask themselves the very question that we look to answer today, and that is, when do I have to make shifts in my allocation? The market got a little bit more sophisticated. You started to see a heightened in volatility, and you got this kind of boom and bust mentality that's happened for the past 14 years, and that kind of shifted over into the asset allocation 2.0 period, where a lot of advisors were still doing things on their own, at least in our opinion, but trying to find and identify those shifts. And I think we've kind of moved in, and we are beginning as an industry to move into a 3.0, which signifies just a little bit more maturity as an industry, and gives a little bit more specialization in the industry, where advisors will now look to do what they do best, and that is go out and raise assets and create those plans and create those asset allocations, and look to hiring and firing money managers that sit inside of those allocations and actually make that decision of when to shift in there for that advisor. So I think that's a little bit what Kevin's alluded to. There's some good articles on it. We reference some of those things in some of our writing. So, you guys just feel free to jump in there and check any of that stuff out. But let's kind of get moving on, because I really want to just kind of blow through this stuff and get into the Q&A session, which is what I think we're all here for. But before we do, I think it's important, because there's so many new faces on here, that we take a step back and kind of understand how we look at the world, and that is the fact that we believe that risk is nonlinear. The old adage of the old diagonal line coming up at a 45-degree angle obviously is no longer valid, at least we don't believe. So when we go back from a broad brushstroke and we look at the nonlinear fashion of risk, it's really kind of a constantly moving target. As Kevin said, a lot of people, they kind of become late to the party, and what happens is, up here in these areas, they actually believe that risk is the least, and for whatever those reasons are, they get in, and that, of course, typically is when you have now another cyclical drawdown or a bear market. And down here at the bottom, a lot of people believe that risk is the highest, when in fact it's actually the least. So this is kind of how we look at the world, and we are a tactical shop that has developed an algorithm that runs around and identifies this risk for us through a multitude of different ways. And it's kind of best seen, and most people equate that actual cycle to this cyclical trend or business cycle, which lasts about 1 to 5 years. So what makes us a little bit more unique versus a lot of people on the street is that we don't just have two stances. We don't just either go bull or bear. We have a neutral stance in between each one. We go from bull to bull neutral to bear neutral back to bull. And when Kevin talks about that stagnating volatility, he's talking about these periods up here where you can have, these huge pops in price.
They can average, Josh, I'm sorry to cut you off, but yeah, they can average anywhere, depending on the length of time that you're looking at. If you look at the top of '07 or you look at the top of 1999 and 2000, even going back to some of the times that you saw back from 66 to 82, these periods can last as long as a year to 18 months and can vacillate 10 to 18% and do it on a monthly basis.
Right. And so that's the challenge, is a lot of people get in here and they see these pops and they think, oh, we're in the next secular bull market, or we've got to get going. And, you know, right, wrong, or indifferent, it happens. So we look at these neutral phases, and what I'll do is, as I go through, I'll quickly kind of overview our portfolios and explain how we navigate these cycles. And again, I just want to reiterate the fact that we are more of a quantitative shop, and that we do have a rules-based way of looking at the world to pretty much eliminate all subjectivity. And the basis behind every one of the portfolios, regardless of what its purpose is to reallocate towards these bottoms and catch economic expansions. And then that is to decrease risk as we come up here into the stagnant volatility places, and obviously then go into more of a risk off, or in some of the other portfolios actually short into the market and sidestep these cyclical drawdowns in here. And by doing that over an extended period, we can by far outperform any of the market, even if we don't capture 100% of these profits in these bull markets. Just the sheer fact that we're decreasing volatility up here and sidestepping these cyclical drawdowns give us a huge advantage over a cycle period, which could be, as in this case, we're a little long in the tooth, but we're on the 5th year of this cyclical cycle that started at the bottom of 2009. And I really won't get any more into detail than that. You can see it's all based on the 100-year market theory, which goes in, and that's what Kevin published originally in 2003, stating we'd be in a sideways channel for the next 15 years, and that these cyclical cycles were going to be much more important than these past secular cycles. So if anybody cares to read any more on that, there's some stuff on our website, but we'll get into kind of the portfolio overview. And Kevin was referencing our conservative growth, and that's called SAGE, but it's a conservative growth sector rotation strategy that's focused on reduced volatility growth over an extended period. And it is tactically designed to, it employs a hedge throughout these tops to decrease the volatility, obviously decrease risk, take that off the table. And then when we have a confirmation of a cyclical bear market inside of our algorithm, we'll actually bring that portfolio to protect all of the principal down to a beta neutral standpoint. And I think the really cool thing is we don't just sell everything and move into cash. We will hold all of the industry groups and sectors that would be on that rotation side around the core strategy until their fusion analysis is deteriorated, the fundamental technical and behavioral aspect of those individual positions gets deteriorated. We'll have those stops in place. And of course, what happens typically is as this market comes up, we're going to be much more involved in these cyclical sectors of the economy, and we're going to have a core allocation into the market general that's going to be into whatever the spiders or the Qs or whatever is necessary, then rotated around with those sectors and industry groups to add that extra alpha. As the market and that cyclical cycle begins to get a little bit long in the tooth and we start to see that stagnating volatility, what we do is through this period here, as Kevin said, where you can have these massive swings, and when he talks about stagnating volatility, what we mean is you're seeing the volatility really increase, but prices really aren't doing anything. They may be up 2% today and down 2% tomorrow, and so on and so forth. But at the end of a month or at the end of a quarter, or at the end of the year, you know, you ran around in circles 42 times just to end up in the exact same spot. Not something that a lot of people want to get involved with. So what happens is in our conservative sector rotation, we'll actually decrease our core position and decrease the actual exposure to the broad market, and naturally our sectors and satellites of the industry group will be allocated over into more defensive economies, defensive sectors and industry groups of the economy. And ultimately, if this thing continues to consolidate, which it could, and then turn around and come back up in here, we'll reallocate into that expansionary phase. And if it comes down and confirms a cyclical bear, we'll actually button up the hatches and bring our exposure down to beta neutral and ride this thing out. until we get down here into these bottoms, this bear neutral phase, and you'll see a natural progression in that portfolio of it beginning to shift over back into these cyclical sectors of the economy. So that's our conservative growth. We have then an actual long-short growth. And this portfolio itself is a market general ETF portfolio that is actually designed, again, to capitalize on cyclical bullish and bearish phases. So what it does is it can capture the 5 to 25-year trend and the 1 to 4-year trend, and it actually goes from 100% long to 100% short. And through those topping patterns, we have a little bit slower hedging mechanism that's what's involved in our conservative growth portfolio. So if you take a look at that business cycle that we just outlined, and suppose, it could be up for argument, but suppose we're up here, kind of in this area somewhere currently. It could be debated whether we're over here or up here, but I think everybody would agree we're getting to a pretty extended point in this cyclical cycle, and at some point we're either going to come into an extended consolidation, we're going to see a bear market, or we'll see kind of a pop topside here and then more consolidation. But what this portfolio is designed to do is, as this market comes up and turns, we're not going to limit the volatility as much as we do in our conservative growth portfolio. We'll do it a little bit. But what happens is, as this market comes back and breaks and we get a confirmation of a cyclical bear with our algorithm, we actually shift the allocation in this portfolio so it goes down into a 100% short stance, which in reality comes in and obviously can decrease the correlation of a lot of the allocations that you guys have with your clients. Instead of only just buttoning up the hatches and kind of going into protection mode, you actually can add alpha during these cyclical bear markets, which can obviously greatly enhance the overall return of that portfolio. But as you can see, it's all about capturing these upturns and sidestepping these downturns. And we have an algorithm that predicts these going back to the 50s, the beginning of the S&P 50 or 63, and is over 90% accurate with it. So that's kind of how Pulse works. And I'm going to go through real quickly and talk about our income portfolio, and then we'll open it up to questions and answers. And we'll talk about how a lot of the people that we're in conversation with are beginning to use these in ways, which is some of it's very creative, to decrease some of their risk factors in today's market. So BIG, obviously, is our risk-controlled income strategy. There is a little bit of growth on the back end of this thing, but really, primarily, this is an income-focused portfolio. It's an alternative income-focused portfolio. And again, I think one of the unique things about this one in particular, like most of our other things, is it actually can hedge during a cyclical market drawdown, and we can explain that a little bit as we get going. But you can see the 2014 return in BIG is doing very well. 2013, we kind of did as expected with some of the turmoil in the income markets. But what we do with BIG is we actually will stay invested in this portfolio, and we'll take a piece of the allocation out of BIG through these tops and bottoms, and we'll decrease the risk in that by actually hedging the portfolio and bringing it down to a more decreased exposure. The most interesting thing about this is, through an income portfolio, typically what it does is, when you go through these cyclical bear markets in the income market, you'll see yields begin to increase. I think everybody knows that, is obviously people are going to increase their dividends and things like that to get you to buy into the securities. And so what happens is, again, we don't just sell out of all of our positions completely when we get into a cyclical bear market. We actually button up the hatches, hold on to those until they're deteriorated, then reallocate those positions. So typically, when you get towards these bottoms, you'll get a higher yield ratio on those. And how we calculate BIG, which is really interesting and I wanted to share, is we just use what's called an efficient frontier. So we get the maximum amount of return that we can get based on a certain allocation in this alternative income portfolio, with the maximum amount of yield and the lowest amount of correlation. And that dot right there, where all of those lines cross in the center, makes up the actual allocation of our income portfolio. And here's what it looks like when we run the regression analysis with our algorithm. And you can see these are all the iterations of the possible combinations that you could have in that actual portfolio. And right in here, this one right here would be the efficient frontier. So that is the actual allocation that we make into that. And of course, this is run on a daily basis to ensure that we're doing what we need to do for our clients. So I think in summary, we're getting ready to open this up to questions. We have begun already to reduce our exposure in Sage. I kind of breezed right through it because I wanted to get through some of this stuff. But we're actually at a 50% exposure stance in Sage. One of the other nice things about our conservative growth portfolio is we're at about 34% less of the volatility than the market. So it's doing exactly what it's designed to do. With Sage, we haven't reduced exposure in VIG, our income portfolio, or our long short. As I said, those are a little bit slower than our conservative growth portfolio, but our income portfolio has a current yield, as Kevin stated, about 6.2%, half of which is tax-free because it's in the MLPs as well as some municipals. And that kind of vantage window is really narrowing. I think VIG, for all intents and purposes, is a great it's a great place for investors to come in. So what I'll do now, Kevin, is I'll open this back up to some Q&A. And if anybody in here has any questions, and I see a few of them have started to come through, so please go ahead and continue to type those questions in the chat section. I'm going to open it back up to Kevin. And while I let you guys come up with some questions, I wanted to share some ways that some of the advisors that we're working with are looking to implement some of our strategies to help them in case of a cyclical downturn, and some of the guys that we are working with actually are doing. Because there's a couple different ways that you can look at this, and depending on the type of advisor and how you run most of your assets, a lot of advisors, particularly with our income portfolio, are just sleeving that in as a piece of their core. And that's obviously going to do a lot to protect them. It is more of an alternative income portfolio, so we're going to be into things, like I said, like MLPs, REITs, and that type of thing. Obviously, REITs right now aren't that attractive, but as they do, we can get involved with some of those. Now, Sage, our conservative growth portfolio, a lot of our advisors that we're talking to are looking at either A, using that as a core. Most of our portfolios are designed as core. We're actually sleeving it in as a piece of the core to decrease the correlation to the market, obviously, and protect some of that risk if we do see a downturn. So a lot of them are using Sage as a core. Some people are talking about sleeving in a piece of the core with Sage and Pulse, which is our long-short growth portfolio. But I think one of the most interesting things that I've heard is in the actual overlay concept that some of the people we're talking to are looking at doing. And what they're looking at doing is, if you just take whatever, just say a traditional 60-40 allocation, they're actually trimming that back to, say, a 50-30, and they're taking that 20% and putting it into our long-short as an overlay, which obviously is going to decrease the correlation to the market, help with some of that downside capture rate, which obviously is going to help help lift those returns, that alpha, and decrease that beta through any type of cyclical bear market. But we do have a couple questions here, and Kevin, feel free to jump in here anytime. I can give you guys I answer any questions as well. We have a question here that says, how much of the decision process is rules-based versus subjective? And I can tell you that our decision process is 100% subjective. So we are, 100% rules-based. We are not a subjective firm. If you heard Kevin talking earlier, and the fact that we are a quantitative shop, we use diffusion analysis, and we tie that up using a quantitative algorithm. So we are a rules-based shop, which eliminates all subjectivity out of our decisions.
I'll actually foster that even further. I'm not sure who the gentleman was that asked, but let me explain a little bit further on that subject. A lot of people ask that question for a multitude of reasons. So one reason could be, okay, well, what if I don't believe in a computer? Or the other reason could be, well, I've heard tactical people or tactical shops say that they are rules-based, but yet alleviate and still lean on a lot of subjectivity. So I'm not really sure the crux of the answer or the reason for the question, but I'll answer it to hopefully hit both of them. So number one, when you look at a rules-based system, remember it's not a black box, but a rules-based system is where you can remove that subjectivity of, if your portfolio manager, gets, his wife yells at him, or, goes out too late one night, or whatever the case may be, and has problems the next day, or maybe even doesn't show up to work. You have something that you can work off of, and that will not be subjective. These rules are based on the fact that when somebody sits in a computer, they make those rules and they look at them over their experience, right? Wisdom from experience is really the title of SAGE. And when you look at it from a historical standpoint, that experience that you have of the 25 years, you can write those down and be able to subject them into an algorithm. The other question and the ability to circumvent any kind of subjectivity, but the other issue is, well, what happens during a black box? I'm sorry, black swan. Sorry, I said black box. I was thinking about black box. So the black swan events, right? The 9/11s of the world, the flash crash of 2010. The issue with Greece, whether people actually called that a black swan or not. It doesn't really matter, but the point being is that there's always going to be a human at the other end of it, at least at our firm, that takes the information that comes out of the quantitative algorithm and inputs that data into the actual trade itself. So the human intervention comes down into the last and final. Is there something that could circumvent that of why this decision is being made? Now, that has never happened, nor any of the back tests that we've ever done, and as Josh mentioned, goes all the way back to the inception of the S&P 500, which is actually 1953 is the data that we have. So let's just assume it's 50 years. When you look at that, I'm sorry, 63. And when you look at that data, we've never once pulled that black swan card out, but we do have it. And if there is a situation like a 9/11, we will implement it and make sure that those decisions are made properly. So I hope that answers your question.
Yeah, it looks like we have another question here. We got a couple of them coming through. So, and just so everybody knows, we'll do our best to get everybody's questions answered. We'll stay on here as long as we need to. But if we don't, for whatever reason, feel free to call us. So here's another one, Kevin, and it really is talking about where are you guys with respect to the next decline? Are we now in a secular bull market and should experience a cyclical bear? But I think really the crux, which he states, is what I'm trying to get at is the depth of the decline if it were to happen.
Well, every webinar you got to have one that asks, so I'm glad you asked because this is a question we get every time. So let's talk about it real quick. It's not an easy answer, but I'll try to make it as easy as possible. The confirmation of price through the top of a secular channel is typically what people look at to say we're in the next secular bull market. In my opinion, that is completely inaccurate. There's a multitude of times in the last 100 years that the market has surpassed its secular channel, right? This isn't, you can't draw a line and assume that line is going to hold pat. If you did, it's a fool's errand. I mean, you've got to be realistic about the situation. You have to be realistic about the fact that we have pushed $3.1 trillion into the system. You have to be realistic about the fact that there's a lot of things that are changing, and we're talking about a 100-year theory. So going back to your answer, and that is, for me, you have to have confirmation that you're going into a new secular bull. And that confirmation, one of the issues, if you do go through the top side, is to come back down and retest that, hold that level, and then take off. It happened in 1982 to 1983, which is in the last secular channel. It happened when you went through the 1937 and the 1950. When you broke out in 1950, you came down and retested and you went back up. Happened in 1924 when you broke out of the 1924 channel and you came back down to 25 and retested before it went back up. I mean, it's typically technical analysis. You've got to have that, okay, we're too high, let's watershed it, and then you've got to have the buyers take over. So that would be number one. Number two, your question is, how far is the decline? Your question really stems of what is it going to look like? How deep can we go? Well, that answer is anybody's guess, but I can tell you on a quantitative basis when you look backwards, and you can pick this up and you can look at that data that we put out in the book. When we published the book, we tried to answer that question, the evolutionary perspective of investment risk. And if you go into what I happen to believe to be, once Janet is finished with her tapering and we stop buying and the Fed actually changes its tone and starts supporting the system, let's say, and God forbid should the economy not hold up and anything else that comes into play, I actually believe that the third leg and the final area of a secular channel is deep volatility. What I mean by deep volatility, I don't mean you're going to get a bear that you've seen. I believe that the largest cyclical bear is over, and that was 54%. It was actually the largest cyclical bear ever in history. If you look at it that way, understanding that the Great Depression was a secular bear. But going into the latter half, the end of the latter half, typically what you'll see is a smaller channel within a channel. So let's say the depth of the channel that we are in, and let's just use the S&P because it's simple, right? So 1550 was the top. The bottom was, as everybody knows, 666. And you look at that, and you look at that differentiation of spread and say, okay, so that's somewhere in the area of 40%. The likelihood is you're going to get about 65 to 70% of that when you look at the average going back when you get these declines. So going into the latter half of the channel, if things were to be accurate, I would expect somewhere in the vicinity of, this is going to be scary, and I'm not saying this is going to happen, but maybe even 900 to 980 would be a good guess if you were to go into actually a cyclical bear market, as I would expect that is possible. I'm not going to tell you that is going to happen. That would just, again, be a fool's errand. We don't predict. The predict is a horrible, horrible word. I'm not going to pontificate about, a crystal ball and telling you where the market's going to go. What I can tell you with absolute certainty in my mind is that I can tell you where the risk is. I can tell you how high the risk is getting, and I can tell you when the risk wanes. And if I know those, then I can help understand where we are in that cycle, because risk is not linear. It's a cyclical move. And it is a cycle. So when we look at this, I don't look at it in the depth of where it could go when something starts to begin. What I know is that I have to make this shift, and until that changes, I'm going to stay in that stance. Whether that stance is 12% or whether that stance is 48%, because the risk has not shifted or has not changed. So I don't know, again, if I answered it completely. I hope I did. So to button it all up, no, I am not absolutely confident, and I actually don't believe that we are in a secular bull cycle, the next secular bull cycle of the marketplace. If I'm wrong, that's okay, because the market's going to continue to go up, and I'll be happy with it, and we'll shift to, even our conservative growth will shift to this stance. But in the interim, there's going to be instances where you'll see declines of anywhere from between 15 to 18 to 22 to possibly even 30+% declines in the marketplace that will give us an opportunity to either reorient long or make sure that we buttoned up and possibly even go short.
Right, and I think to just expand on it and lead kind of into one of the other questions that we have is Bob was asking about our timing indicator, how is it calculated, and obviously showing our current readings. And so what I've done is just taken kind of a snapshot of the S&P 500 here, dating back to its inception in 1963. I've put it on the screen. This is in our capability brochure, but don't worry anything about any of this up here. This was a portfolio that we ran before we started this firm when we were at Wachovia, and we lifted out. It was an individual equity portfolio, built a lot on the same philosophy. Now we run ETF managed portfolios, but what I want everybody to see is down here towards the bottom, and Kevin can lend some insight into this as well, but this would be what you would take if you took our algorithm and put it on the S&P. Whenever it's red in here, you could see we would believe at that time that risk is very high. So for example, in our conservative growth portfolio, we would be to pretty much a beta neutral stance. In our long-short growth portfolio, we would actually be short the market, and in our income portfolio, although this isn't on the income market, but we would essentially be beta neutral as well, kind of holding some of those positions. And then, as this thing bottomed out here in '03, we would then begin to shift back into a long stance when you see it and it's green. And you can see going back all the way to 1963, this is the rules-based system that really is the core of everything that we do here at TAM. And it starts from a top-down level on the 100-year market theory and the quantification of secular and cyclical trends, and then comes from a bottom-up. We use about 27 different metrics that are ran, and I can't even tell you how many iterations we've ran to find just the right side. Kevin could probably talk a little bit about it, but that's what this is. So from a very simplistic standpoint, when this is red, we're either risk is really high in our mind, and what we're talking about, I think what gets most people confused, it's hard because they can't zoom in, but are these tops and bottoms, and that's where we see a lot of that stagnant volatility, as Kevin calls it. You see these huge whips, these ups and downs. People get very emotional. The sensationalism across the media is high, and risk is obviously the highest up here. Some people think that it's the lowest, and vice versa. So hopefully that can help answer a little bit of question from a visual standpoint, anyway.
I think just to go on what Josh was saying, and you have to forgive me, I think you said his name was Bob, but yeah. In regards to Bob's question, he asked, what is it made from? And what are those signals, which is a question that we get all the time. Well, first of all, if I told you, it's one of those things, the old adage, if I told you, I'm going to have to kill you. So I'll let you know this, and I'll tell you what I tell everybody, is the metrics when you look at behavioral finance. You can take things such as risk, direction, move, slopes, volume, add that in between technical. You can look at again, when you look at fundamentals, you want to look at it, well, at least we do. We look at it quantitatively. We don't look at qualitative fundamentals, meaning, okay, how good is the management team? That's something I can't measure, right? But when you look at the market in general and you put these metrics together, as Josh saying, we have a multitude of metrics that we've narrowed down to approximately 27 that I've used in the last 25 years of managing assets to look at it and say, okay, these metrics are the ones that were on my checklist. And then what we've done is we put those into an algorithm and ran it backwards and said, okay, how good were my metrics? And then we improved on it and we made it so we know that as this index shifts, that these are the areas where the risk is the highest, and this is the area the risk is the lowest. Now, this one is very simple, what Josh is showing you. The CTI, it's a great index, and it is the core behind what we do. It doesn't show you all four stances, which Josh mentioned earlier. We have bull, bull neutral, and bear neutral. This shows you bull and bear. As he mentioned, the stagnant volatility or stagnation in the volatility areas, those are the areas where you really fall into something that you don't see here today, and that is the algorithm that pushes out and tells us when we're actually in the neutral zones. And that is maybe some of the question that you had, and that is, are we in that now? And I can tell you that we're getting close. We're leaning into it, leaning into the wind, right? So, and there's a lot of risk that is out there. Risk that is not being measured, that is out there today. And I think that that's where maybe your question came from, but how is it all implemented into the system? I hope that answers it for you, Bob.
Yeah, just to kind of expand on that a little bit too, hopefully it did as well. But, again, this algorithm isn't designed as a short-term, kind of solution. So as Kevin said, we're kind of leaning into that bull neutral stance. Traditionally what happens is it will take it a little bit of time because we want to make sure when we make those shifts that we're certain to decrease, obviously, the turnover in the portfolio. And we've done that based on the iterations and the back testing and the modeling and all of those good things. So we're getting very close to an actual flag coming up and letting us know where we're at just based on looking what we're seeing. But as Kevin said, some of these tops and bottoms can take 2 years. to form, and I think that's a little bit of the disconnect that a lot of investors have, is they look at the media and the sensationalism, and that stuff is more kind of like day-to-day, week to week, whereas, we look at the world more of like cycle to cycle. And by identifying those cycles and removing that subjectivity and removing that sensationalism, it just gives investors that confidence that they need kind of moving forward. So hopefully that answers a little bit more of the questions. We got another one from Mark. Mark, how you doing? Good to see you again. Actually, I'll probably be calling you after this call's over if you have time. But he says, have we seen a correlation between the Chinese data and the market turns in the past? And to be honest, I don't know if we've actually run some of that data, Kevin. Have you actually expanded on some of those things?
Yeah, actually, that's really good. It's a great question. So the answer to you is yes, there is a correlation, but the correlation is not length. It's strange. The correlation in what has transpired in China is such a short-term period of time, because as you remember, for the last 12 years or so, China's been averaging about 11% growth. Now, I know that the chart I showed you earlier, you saw vacillations of 9 and then 10 and then 9 and then 10, and you saw an 11 and you saw 12. But if you look longevity on the growth, whether it is industrial production or whether retail sales have been very volatile over there, but we are at the lowest level in the retail sales. But when you look at just straight line GDP and you look back at the growth that they've had, they would have one very short-term bubble or a hiccup, let's say, in their GDP due to an event, whether it be an economic event or whether it be a global weather event or whatever the case is. So when I ran the algo, or when I ran the correlation backwards, the trouble being it would stem it from a very short period, and then the U.S. economy would take back off, or China would take back off again, and then we would catch up to it. So we never got a correlation. So I'm going to end this. The answer to your question is no, there's not a long-term correlation, but I'm going to tell you that this is different. And what I mean by it's different, it's the first time that China's dropping below the 20% levels where they've had before. So if you take the second largest economy, what I'm telling you is that even though we haven't seen a correlation because of their strength over the last, let's just say, dozen plus years, my concern is their strength will wane, and it will wane in a very large way. I'll leave you with one thought. One of the Fed presidents, and I'll have to pull the article. If you email me, I'll get you the article. And it came out about 8 months ago, and I can't remember. It's not on the tip of my tongue right now which president it was. And he came out and he said, hey, in a decade, China's growth will be 2% per annum. And he had all these reasons for it, and looking forward over a decade. And if you take the second largest economy, which is growing at the rate it's growing, and then downturn it and say, okay, it's going to grow at 2%, what do you have? What you have is you have Apple Computer. Right? So you have a stock that went from 100 to 1,000 and then dropped to 500 and then set stagnant, right? Because you had massive growth. And now I think they just announced that Apple is the second largest dividend-paying company in the S&P 500. I actually believe that's true. I think I just heard that yesterday. So again, my concern is not, China is a great growing economy. And they're growing at 8% versus 11. I mean, that's debatable whether that's a bad thing. My concern that it's going to foster things much greater down the road. So hopefully, Mark, I've answered your question.
And I think that kind of goes a little bit, Kevin, into what we talk about in the book, the evolutionary perspective of investment risk. We talk a lot about pendulum apexes. And, of course, that would be that rubber band of China going from nothing to something. And obviously, if it's going to swing one way, it's going to swing the other and eventually settle somewhere in the middle. So we do talk a little bit about that stuff, which goes into investor psychology, and a lot of those things are mentioned in the book. And we do have a couple more questions coming in here, but I noticed that we're coming on an hour. So I want to try to, again, be very respectful of everybody's times. I really appreciate everybody's time. Those of you that we didn't get your question answered, I promise. It's not that we don't like you. Feel free to call us, and we'll get any questions answered that you guys have. And Kevin, I think that Fed president might have been one of those crazy guys out of Dallas. You got to watch out for those Dallas guys down there.
you say that, but he's now actually the vice chairman. So even though he's funny and he came out and talked about beer goggles and the economy, he's actually the vice chairman now. So he's not as crazy as you think.
Exactly. So, anyways, guys, again, thanks for your time. We do appreciate it, and again, you got to watch out for some of those Dallas guys. But I do see, Mark, I will give you a buzz about to the Fed. But thank you, everybody, for attending. Again, we're going to do this next month. I'll try to set up another meeting with Yellen and see if I can have her rearrange her conference calls. But if, in the event that doesn't happen, we will try to get something done either a day before or a day after. So, guys, thanks a lot. Again, if you have questions, give us a buzz. Mark, I see it. I'll give you a call. Also, Bob, I got your message. I'll give you a buzz too. So, thanks, guys, for attending, and we'll see you guys next month. Good luck.